Management and internal control systems. Part A. Evaluate the key components or features of effective internal control systems. Internal control is a process effected by an entity's board of directors, management and other personnel, designed to provide reasonable assurance regarding the achievement of objectives, reporting and compliance. COSO, C-O-S-O, is the acronym for the Committee of Sponsoring Organisations of the Treadway Commission, and FRC, the UK Financial Reporting Council's guidance on risk management, internal control and related financial and business reporting are two main sources for guidance on internal control systems. Features of internal control systems are as follows. Control environment. Set the tone for the organisation, how the risk is viewed and addressed by people, including risk management philosophy and risk appetite, integrity and ethical values, and the operating environment. Board attitude, participation and operating style will be a key factor in determining the strength of the control environment. Risk assessment. Risks are analysed considering likelihood and impact as a basis for determining how they should be managed. Analysis process should clearly determine which risks are controllable and which are not. Control activities. Policies and procedures are established and implemented to help ensure the risk responses are effectively carried out. COSO guidance suggests that a mix of controls will be appropriate, including prevention, detection, and manual and automated controls. Information and communication. Relevant information is identified, captured, and communicated in a form and time frame that enables people to carry out their responsibilities, which needs to be of relevance and of top quality. Effective communication should be broad, flowing up, down, and across the entity. Monitoring activities. Risk control processes are monitored and modifications are made if necessary. Effective monitoring requires active participation by board and senior management, strong information system and senior data managers. Part B. Assess the need for adequate information flows to management for the purposes of the management of internal control and risk. All relevant information should be identified, captured and communicated within a time period to all necessary people, which will help them in performing their duties. Information provided to the management needs to be relevant and of appropriate quality. Communication should be wide-ranging, flowing up, down, and across the entity. Communication of risk areas that are relevant to what staff do is an important means of strengthening the internal environment by embedding risk awareness in the mindset of staff. There should also be effective communication with third parties such as shareholders and regulators. Part C. Evaluate the effectiveness and potential weaknesses of internal control systems. The advantages of internal control systems are alignment of risk appetite with strategy, linking growth with risk and return, choosing best response for risk situations, minimizing surprises and losses, identifying and managing the risks across the organizations, providing responses to multiple risks, helping in seizing the opportunities and rationalizing the uses of capital. The weakness of internal control systems are that it is internally focused, which ignores the external environment and the risk they pose to the organization, prioritizes the sudden events in risk identifications over more gradual risks that evolve over time. Risk assessment makes the process appear too simplistic and thus too easy, and stakeholders' involvement in risk management often tends to get ignored. Part D and E. discuss and advise on the importance of sound internal control and compliance with legal and regulatory requirements and the consequences to an organisation of poor control and non-compliance. Recommend new internal control systems or changes to the components of existing systems to help prevent fraud, error or waste. Prevent, detect, correct and direct controls can be put in place to address the issues related to human error, waste and fraud in the workplace. Prevent controls are controls which are designed to prevent errors from happening in the first place. Detect controls are controls that are designed to detect errors once they have occurred. Correct controls are controls that are designed to minimize or negate the effect of errors. Direct controls are controls which direct activities or staff towards desired outcome. Human errors can be defined as unintended action by an individual which has led to an undesirable outcome. Human error can be caused by carelessness, distraction or fatigue. Wastage in the workplace is explained as the loss of organisational resources. Waste in the workplace is often associated with the loss of physical materials or inventory in traditional manufacturing environments, but can also extend to wastage in terms of lost employee time. To reduce the instances of human error, different internal controls can be placed in different processes, such as prevent internal controls, review of list of supplier payments made by account clerk prior to authorizations by finance manager. These reviews might involve cross-verifying invoices received from individual suppliers against the goods received and against the list of supplier payments. This three-way match of documents should help to prevent payments being made for items not received. Detect internal controls. Preparation of regular bank reconciliation should help the organisation to detect whether there are any errors between bank statements and underlying accounting records. Correct internal controls. To reduce the impact of an employee accidentally opening spam mail which could corrupt and hack the system, a daily backup of all data should be able to help the disruption of the system. Direct internal controls. Machines in a factory can be set up in a way that it will not work without the operator using the required safety equipment. To reduce the instances of waste, different internal controls can be placed in different processes, such as prevent internal control, ensuring that inventory and resources coming into the organisations are counted in and are reviewed prior to use to ensure that they are fit for use. Detect internal controls. Factory managers might compare the amount of raw material getting used to produce 100 numbers of units against the cost card information or budget to detect any variance in usages. Correct internal controls. Warehouse managers might conduct a regular review of all inventory, help to identify nearing the point at which they become obsolete. Direct internal controls. Make sure firms' long-haul truck drivers are undergoing drug tests before they take any delivery job.